But we start once again with artificial intelligence in a week when the Chinese came forward with yet another model that they claim is cheaper than the U.S. alternatives and can do just about as well. Stephen Rattner is chairman and CEO of Willett Advisors, which invests the personal and philanthropic assets of our founder and majority shareholder, Michael Bloomberg. So, Steve, artificial intelligence has been all the talk of the markets for some time now, both the investment in it and the promise of it. There are some questions being raised right now. What do you think of those questions? Are they serious questions?
Oh, they're definitely serious questions, David. Let me step back just for a second and say that every technological innovation that I've seen happen has always occurred with sort of a swirling of the cosmos effect where the stars are forming and you don't quite know how it's all going to shake out for a while. And that was certainly true, for example, when we had computers came in. There were many different computer manufacturers, many different systems and so forth, and all the way through the internet. But I would say this time it may be even more dramatic in terms of not really being able to see clearly how the movie ends. The movie's going to end with a lot of artificial intelligence. In my opinion, it's going to be a huge contributor to society, to the economy, to our lives. But exactly who the winners and losers are, I don't think you can say with 100% certainty just yet.
The markets have been very enthusiastic, I think it's fair to say, with a broad brush so far. We're now starting to see perhaps a little hesitancy on the money being borrowed as you see some of the spreads really increase for the hyperscalers. Are the markets having some doubts now about the repayment of all that money?
Not about the repayment per se. I mean, the widening of the spreads is still quite modest relative to where they were and relative to other spreads for other kinds of companies. I think the market got caught up in a little bit of irrational exuberance, to borrow a phrase, when Google and others financed all that debt and gave them pricing that was really kind of rock solid, very, very high investment grade pricing. And I think on reflection, the market is saying, well, they're good companies and they've still got $1 trillion plus market caps, but shouldn't we have a little bit more of a margin of safety? You saw in Google's earnings earlier this week that they're actually potentially running cash flow negative now because of all the capex. And that isn't the end of the world. It's not terrible, and hopefully the capex will be justified. But the market just wants to be paid a little bit more for it.
And as you say, there's going to be a lot of AI, however it all plays out, no question about it. One question, though, that did come up, particularly this week, is what kind of AI will it be, given what we saw coming out of China? Whether, in fact, we need the silver-plated special version that's very out there and advanced, or is there something that's a little less powerful, but perhaps much cheaper?
Well, yes, and so that is the absolute question of the moment, is who are the winners? I'll call it who are the winners and losers going to be. We had a few months ago, as you well recall, the DeepSeek moment where China first kind of raised its head in a way where people said, aha, they actually have something. And now we've had a number of different developments in China that lead us to think that, again, they have very robust models. It has been tested that their newest models are not quite as good as ours, but they're close. But they come at a fraction of the price per token. A token is the unit of purchase of artificial intelligence. That's a big question, and it is in some ways not that different of a question than the question of competing against anything else China does, whether it's cars or whatever. But in some ways it is a more complicated question because of the potential of information leakage the wrong way and things like that. So we're going to see how it unfolds. What you're going to see, and what you've already seen, are a number of companies getting in the business of essentially intermediating between the user and the LLMs, and essentially going out and you ask it a question or you ask it to do something, and it figures out the least expensive way to get what you want by going, whether it's model A, B, or C, and then coming back, and it might be a bit of each for that matter, or one question might be all of the cheapest or all the most expensive. So you're going to see things happen there. The token prices in China are as little as 5% of what they are here, and so we're going to have to deal with that.
One of the features of the Chinese approach is so-called open source, open weighting, where most of the U.S. systems, the advanced systems, are not. Should we expect a new generation of AI to come up in the United States that follows the open source, open weighting approach?
I'm not going to take credit for this remark, but I read it somewhere and it was sort of amusing to me, which is that the most authoritarian country in this ecosystem has the most open models of AI, and the most open country in this ecosystem has the most closed models of AI. So it's sort of just a little irony that China and we have gone in such different directions. Do I think there'll be open source models here? I think it's possible. I think it's possible. I can't say I know of one right now that I would bet is going to either emerge and be of any consequence, but it's certainly possible.
As we talk about the price of borrowing overall has crept up here, where we have the yield on the 10-year significantly above 3.5 now, and on the 30-year U.S. Treasury really above 5.1. What is causing that?
Right. So I think that you could maybe draw a little bit of a line to AI, but I don't think it's one that is meaningful, and I would not go there in terms of looking for answers to your good question. And of course, the only right answer is nobody really knows. But I think the factors that are out there that are weighing on the market are certainly inflation, which, while it went down last month, will almost certainly go up next month, given what's happening to oil prices as we sit here today. And you also have the fact that the federal budget deficit is still high and, in fact, going higher. It was $1.8 trillion last year. It's going to be $1.9 trillion this year. It's going to be $1.9 trillion next year, and then it goes up from there. And we are going to exceed our highest level of debt to GDP, which was 106% in 1946 at the end of World War II, and keep going up from there. And this is something, of course, as you know, that economists and Wall Street types have been discussing for decades, which is at what point does the Treasury market sort of roll over and say we can't take any more of this. I'm not here to say that that's happening now, and I'm not here to say it's ever going to happen. Treasuries have always been viewed by the market as rock-solid investments. But certainly the amount of debt and borrowing that's going on by the U.S. government is playing a major role, as is inflation and other uncertainties in the world. But basically, it's a function of inflation and borrowing.
And as I look around, it's certainly a United States problem. It's not unique to the United States. We see it in a fair amount of the Western world where fiscal situations have really deteriorated. The balance of debt to a balance sheet has really grown.
Yes, we have this problem in other countries as well as here, with high and growing debt loads as they deal with the same issues we deal with, aging societies and so forth. And you saw this in Britain in the very brief Liz Truss moment where she tried to propose a budget that would have increased British borrowing by a material amount. And the market just threw up on it and said that's not happening. And, you know, it wasn't that long ago, maybe 50 years is a long time, but it was, I think, around 1976 that Britain needed a rescue package from the IMF. And so, so these countries, we have the advantage of being the ultimate reserve currency. We still are. People still want U.S. Treasuries. So that, in a way, is an advantage. It's also the disadvantage that if you can do things you shouldn't do, you sometimes do them.
Steve, you are responsible for a large number of investments around the world. As you look at the increasing borrowing costs we're seeing right now, as I say, creeping up, but nonetheless moving in that direction, how does it affect your investment decisions? Does it affect what you invest in, what you keep investing in, liquidity? How do you take it into account?
Yeah, it does affect it. It affects it in several ways. In maybe reverse order. It does make investing in fixed income, i.e. debt, more attractive. We're not really big debt investors. We did some of it a few years ago, about 5 years ago, when we thought there was a moment where both rates were high and spreads were wide, and so we could achieve attractive returns. I don't think we're near that level, at least for our appetite. But for many investors, when they see the 30-year go above 5%, they think, maybe that's a better bet than being in stocks that could go down or whatever. So that is certainly one thing that affects investing. The second thing that affects investing is that, and we learned this in 2022, when a lot of the software companies had real problems with their valuations, because what happens is the market, when you have a company where the cash flows are way out there in years, the market uses a discount rate to arrive at a present value of those cash flows, and therefore an appropriate stock price. When interest rates go up, the discount rate you use goes up. And so companies where most of the earnings are on the come, so to speak, are hurt with higher interest rates. And that, yes, to anticipate a question, that could well affect some of the AI companies and things if interest rates continue to go up. The third place that it has an effect that we have to be mindful of is when we make private equity investments that involve significant amounts of debt. If the cost of debt goes up, then obviously the cost of operating this business goes up, and therefore you can't pay as much for it. So it is having something of a limiting factor on our ability to do private equity and make the kinds of returns that we want to make.